If you think the 2008 financial crisis was just a housing problem, here's the frightening truth. A single mortgage in a quiet suburb could be sliced, repackaged, insured, reinsured, and sold around the world like it was as safe as cash. And when that one mortgage went bad, it didn't just hurt a lender or a homeowner. It sent shockwaves through pension funds, banks, insurers, and entire governments, until the global economy started to freeze in real time. This is the story of how greed turned debt into a product, how subprime mortgages became financial weapons, and how a system built on confidence collapsed the moment people realized the numbers were a lie. Picture America in the early 2000s. The country is still bruised from the dot-com crash. Interest rates fall, money gets cheap, and a simple idea begins to feel like a law of nature. Home prices only go up. At first, it looks like a golden age. Construction booms, realtors flourish, families who never imagined owning a home suddenly qualify, and Wall Street sees something even bigger than the American dream. Because a mortgage isn't just a loan, it's a stream of payments. And a stream of payments can be turned into a security, something you can sell. That's the heart of the machine, securitization. A bank makes a mortgage. It doesn't plan to keep it for 30 years. It sells it to be bundled with thousands of other mortgages. Those bundles become mortgage-backed securities, or MBS. Investors buy them for income. The bank gets its money back immediately and can make more loans. And that sounds efficient, until you realize what it does to incentives. If you're a lender and you're not holding the risk, you stop caring about the borrower's ability to pay. The goal becomes volume, more loans, faster approvals, bigger commissions, and soon, the rules of borrowing begin to melt. Enter the subprime mortgage. Loans made to borrowers with weaker credit, less income documentation, or higher debt. In a normal world, subprime loans would exist, but they'd be priced carefully and issued cautiously. In this world, they became fuel. Loan officers started approving people with no verified income, stated income loans, no doc loans. Borrowers joked they were liar loans because you could say almost anything and still get approved. And then came the teaser rates. Mortgages with low introductory payments that later reset sharply higher. Adjustable rate mortgages that looked affordable at first, but were ticking time bombs. For a while, nobody cared, because home prices kept rising. If you couldn't afford the payment after the reset, you could refinance. Or sell the house for a profit. But that only works in a world where prices never fall. Wall Street didn't just buy mortgages, it engineered them. Banks and investment firms took mortgage-backed securities and went further. They created collateralized debt obligations, CDOs, structures that pooled slices of mortgage bonds, including risky ones, and then carved them into layers called tranches. The top tranches were supposed to be safest. The bottom tranches absorbed the losses first. And here's where the alchemy happened. By mixing enough loans together and structuring the cash flows, firms claimed they could transform risky mortgages into top-rated securities. And the rating agencies, companies whose job was to judge risk, often stamped these products with AAA ratings, the same grade given to the safest government or corporate debt. Think about that. Mortgages issued to borrowers with shaky credit, sometimes with minimal documentation, were being packaged into securities sold as ultra-safe. Why did that happen? Because the system paid everyone to keep believing. Mortgage brokers earned fees for originating loans. Lenders earned money for volume. Investment banks earned massive profits packaging and selling securities. Rating agencies were paid by the very firms whose products they rated. And investors around the world were hungry for yield. Returns higher than government bonds, but still safe. So the machine kept running. And then the machine got an upgrade: insurance. Not insurance in the traditional sense, regulated policies with reserves and oversight, but financial insurance. Credit default swaps, or CDS, were contracts that paid out if a bond defaulted. In theory, they helped manage risk. In practice, they made it possible to bet on failure, magnify exposure, and build a hidden web of obligations. A firm could buy a mortgage bond, then buy CDS protection to insure it. Or a firm could buy CDS without owning the bond at all, like buying fire insurance on your neighbor's house. And the more CDS were written, the more interconnected the system became. One company became a symbol of this dangerous illusion: AIG. AIG was an insurance giant, but its financial products division sold enormous amounts of CDS protection on mortgage-related securities. When those securities were rated safe, AIG didn't have to post much collateral. It looked like easy money, until the ratings started to crack. Because underneath the financial engineering was the simplest reality in economics. Borrowers had to pay. And by the mid-2000s, cracks were forming in the housing market. Home prices peaked in the summer of 2006. Then the momentum slowed. In some places, prices stopped rising. Then they started falling. And once prices fall, the whole refinancing escape hatch slams shut. Borrowers who took out adjustable-rate mortgages faced resets. Payments jumped. Defaults rose. Foreclosures spread. And as defaults rose, the value of mortgage-backed securities dropped. But not just the risky tranches. The panic spread upward because nobody could confidently price these complex products. They weren't traded like stocks with transparent prices. They were often held on balance sheets, valued by models, and marked in ways that assumed stability. Now those models were failing. And that's when the crisis revealed what it really was: a confidence crisis. Banks didn't just lose money, they lost trust in each other. Because if you're a bank and you don't know how many toxic mortgage assets the other bank holds, you don't lend to them. Even overnight, even for routine operations, credit markets began to seize. The public saw headlines, but inside the system, it felt like oxygen disappearing. The first major shockwave hit in March 2008. Bear Stearns, one of Wall Street's big investment banks, was suddenly in trouble. It relied heavily on short-term funding, borrowing constantly to finance long-term assets. When lenders lost confidence, Bear couldn't roll its funding. It was a bank run, but in suits, behind screens, at the speed of modern finance. The solution was a rescue. Bear Stearns was sold to J.P. Morgan Chase, with the Federal Reserve stepping in through a special vehicle called Maiden Lane to take troubled assets off the table. It was a warning shot. The system was fragile. But the summer of 2008 brought more bad news. Two institutions sat at the center of American housing finance: Fannie Mae and Freddie Mac. They were government-sponsored enterprises that supported the mortgage market by buying and guaranteeing mortgages. As the housing market deteriorated, their stability became a national concern. And then, September 2008 arrived, the month the world changed. In mid-September, Lehman Brothers collapsed. Lehman wasn't just a company, it was a pillar of the financial world, a 158-year-old investment bank. When it filed for bankruptcy on September 15, 2008, it became the largest bankruptcy in U.S. history. And the message to markets was terrifying. If Lehman can fail, anyone can fail. The next day, panic spread to AIG. AIG had written so much CDS protection that when mortgage securities fell and AIG's credit rating was downgraded, it faced massive collateral calls, demands to post cash it didn't have readily available. On September 16, 2008, the U.S. government stepped in with an emergency rescue, an $85 billion loan from the Federal Reserve in exchange for a 79.9% stake. This wasn't a bailout because AIG was beloved. It was a bailout because AIG was wired into everything. If AIG collapsed, the losses would cascade through banks and funds across the globe. Now the fear was no longer theoretical. Money market funds, normally seen as safe places to park cash, were hit. One of the most famous moments came when a major fund broke the buck, meaning the value of shares fell below $1. That was supposed to be almost impossible. It shattered the illusion of safety. Businesses started worrying about payroll. Households watched retirement accounts drop. International markets plunged. And governments realized they were staring into a financial abyss. In early October 2008, the U.S. passed a historic rescue package, the Troubled Asset Relief Program, or TARP. The law authorized up to $700 billion, though later the authority was reduced. Over time, about $443.5 billion was dispersed through various programs. TARP became one of the most politically explosive policies in modern American history. To many, it looked like the government was rescuing the very institutions that helped create the disaster. But policymakers saw it differently. Without intervention, the financial system could collapse entirely. And here's the part most people forget. TARP didn't just buy toxic assets. A major part of it injected capital directly into banks to stabilize them. The goal wasn't to reward bad behavior. The goal was to stop the bleeding. Even so, the damage was already spreading beyond Wall Street. Credit tightened. Companies couldn't borrow. Consumers pulled back. Fear became a force in itself. The economy fell into the Great Recession. Unemployment surged. By October 2009, the U.S. unemployment rate reached 10.2%, the highest since the early 1980s. That number represents millions of lives disrupted, families cutting back, dreams postponed, homes lost, careers derailed. And the crisis didn't stay American. European banks had bought U.S. mortgage-related securities. Global trade slowed. Confidence collapsed. Countries faced recessions, budget strain, and political unrest. This wasn't just a financial crash. It was a global economic shock. Now, here's the question that hangs over all of it. How did so many smart people miss it? Some didn't miss it. They warned. But warnings are easy to ignore when the party is still going. During the boom, risk looked like opportunity. Leverage looked like efficiency. Complexity looked like sophistication. And when you're making money, it's hard to admit the system is unstable. Because instability threatens not just profits, but status, careers, and entire business models. The official investigations that followed painted a brutal picture. One major conclusion was that the crisis was avoidable, and that it was driven by an explosion of risky lending, securitization, and a failure to act on obvious red flags. But the crisis wasn't caused by one villain. It was caused by a chain of incentives. Homebuyers wanted homes. Some took loans they didn't fully understand, trusting that prices would rise. Brokers wanted commissions. They pushed volume. Banks wanted profits. They wanted market share. Investors wanted yield. They wanted returns that felt safe. Rating agencies wanted business. They wanted to keep clients happy. Regulators, in many cases, trusted the market to self-correct, or lacked the tools, urgency, or political support to intervene. And the result was a system that looked stable only because everyone agreed to treat it as stable, until reality arrived. So what happened after the crash? The world didn't simply reset. It rebuilt, unevenly, painfully, and with lasting consequences. In the United States, sweeping reforms followed, including the Dodd-Frank Act, which tightened oversight, created new consumer protections, and aimed to reduce systemic risk. Banks were pushed to hold more capital and face tougher stress tests. But the story didn't end in 2010. Even years later, debates continued over whether regulation went too far or not far enough. Some rules were adjusted, some were rolled back or revised. And the same fundamental tension remains. The financial system needs risk to function, but too much hidden risk can destroy everything. And as of today, one of the most important current status facts is this. The rescue programs of the crisis era have largely wound down. TARP, which once symbolized emergency intervention, has been closed, with no remaining troubled assets held by the Treasury's TARP office as of late 2023, marking the end of a historic chapter in crisis response. But closed doesn't mean forgotten. The legacy of 2008 is everywhere. It changed how people think about homeownership. It changed how governments think about bank failures. It changed politics, trust in institutions, and the economic future of an entire generation. And perhaps the most haunting legacy is a lesson that feels uncomfortable but true. The financial system runs on confidence, and confidence is a fragile social agreement. When that agreement is supported by transparency, sound incentives, and real accountability, markets can create growth and opportunity. But when that agreement is supported by complexity designed to obscure risk, when profits are privatized and losses are socialized, confidence becomes a bubble, and bubbles always pop. So when you hear subprime mortgages, don't picture just a loan. Picture a spark that traveled through a pipeline of securitization, leverage, ratings, and derivatives, until it reached the heart of the global financial system. And when that heart skipped a beat, the world felt it. Because in 2008, greed didn't just inflate a housing bubble. It built a machine that could turn everyday debt into global disaster. And the scariest part is that the machine didn't look like a weapon. It looked like innovation. It looked like prosperity. It looked like a system that had finally learned how to eliminate risk, until the moment it proved it never had.
If you liked this video, please hit the like and subscribe button for more.